Welcome back to the channel. We'll be doing a simple valuation model for beginners using Tesla. This is a follow-up to the previous video. If you have not watched part 1, I suggest you do that first before you comment on this video. You will need a background from part 1 leading into the content of this part 2 video. The link to the part 1 video can be found in the description below. As usual, this video is only for educational purpose only and not an investment or any form of advice. Always do your own due diligence. The aim of this video is to simulate the implied share price of the auto business come 2030 and derive an implied CAGR return. You can then ask yourself if it's an acceptable return to take on the risk. The robustness of your model depends on 3 variables you penciled in. Therefore, the video will focus on how to derive and make sense of the variables you have chosen. Share price is driven by fundamentals as well as multiples, which vary with market sentiment. If Tesla sells 20 million vehicles at an average selling price of 35k, annual revenue in 2030 would then be 700 billion. With a price to sales multiple of 5, the implied share price will be 3,500, assuming share count of 1 billion. We will dive into 3 variables in subsequent slides, and they are units, ASP which average selling price, and price multiple. First variable is how many vehicles can Tesla sell in a year. I know Tesla will have Cybertruck and semis beyond cars, but pardon me for using the word cars and vehicles interchangeably, as Model Y will probably make up most of the units eventually. The models assume 20 million, which Elon suggested as aggressive but not impossible. If you look at the table below, production and sales are at 900 plus K in 2021 and will need to grow at a CAGR of 41% to reach 20 million eventually. There are 2 points to take note from this slide. Number 1, Tesla is currently supply constrained, meaning supply outweighs demand, and Tesla simply can't make enough cars for its customers. How do we know this is the case? Customers are facing long waits of 9 months to a year in the States to get a car, and Tesla is already maxing out capacity in Fremont and Shanghai while accounting for supply chain constraints. Also, Tesla continues to expand via increase in space, expansion of current factories, and building new ones in Austin and Berlin. Hence, production numbers are more important to take track than sales for now. Nonetheless, we'll still validate if the 20 million makes sense later. Number 2, the 41% growth required to reach 20 million sales is below the 50% guided by management. This means Tesla can afford to miss by about 10% in growth and can still reach 20 million penciled in for the model. What we have done here is validating the projection of 20 million against current momentum and management guidance, and both suggest it's reasonable. This slide draws subjective conclusion. The top 2 car manufacturers by annual sales are Toyota and Volkswagen. Both collectively sold about 19 million cars across internal combustion engine, plug-in hybrids and electric cars. Assuming 20 million sales from Tesla would mean being the market leader and selling more than the current 2 leaders combined. Is this reasonable? According to the report, these numbers were impacted by the pandemic. Toyota was down 13%, Volkswagen down 18%, Renault, Nissan, Mitsubishi down 29%, GM and Hyundai both down 13% as well. In contrast, Tesla reached 500k sales, which is 36% year-on-year growth during the same year. If you look at the revenue of these automakers on a 5-year basis on Morningstar, you will see that growth is modest or some even shrunk. We will look at that later. What we can infer here is that traditional automakers are past the peak. The move towards EVs is real, as many countries committed to stop selling combustion cars come 2030 to 2040. Once that happens, it will still take many years for EV to completely replace combustion cars gradually over time, as a car can be used for many years. If you believe Tesla can maintain its current lead, plus electric vehicle continue to take share from combustion engine, then selling 20 million in 2030, which the total of top 2 leaders today seem reasonable in 10 years. Again, it's subjective, so feel free to disagree. Moving one level down from total vehicles to EV only. For our discussion, I only look at the dark green portion, which is just passenger vehicles and pure electric vehicle excluding hybrid plug-in. The study suggests that we will see 40 million to 120 million EV by 2030. The last chart assumes no further new policies are announced, and Tesla will then have a 50% market share on a global fleet of 40 million. If more new EV vehicles are announced to drive EV to 30% of total global vehicle fleet, there will be 3 times more EV at 120 million, implying a 17% market share for Tesla. This is the scenario needed to begin to meet emission reduction commitments made in the lead up to the 2015 Paris climate talks. Again, it goes back to your conviction of the level that Tesla can maintain, whether Tesla can maintain today's lead. It helps that Tesla is a consumer product, which means anyone can try it out or easily seek reviews from others to see if the products are really good. Today, Tesla sells 2 in 3 EVs in US. If competition progress is slow, then Tesla dropping down to 50% market share may not seem far-fetched. Now we zoom out to the most macro level. We have talked about global annual sales of all cars and global stock of all EVs. Now we will look at the total number of cars on the road, not just the number of new cars every year, and also include both combustion, hybrid and EV all in. 20 million is a mere 1% of global fleet. You can picture Tesla replacing 1 out of 100 cars on the road every year with their EV. In other words, EV is a small fraction of the global fleet now, and there's still so much runway for Tesla to grow. This is why Elon said that massive scale is required to accelerate the world towards sustainability. The average selling price or ASP has been hovering about 50k. The 25k has been much talked about in reducing the price point of Tesla cars to be more affordable for the mass. But Elon mentioned in the latest earnings call that they have yet to start work on the 25k car. A car that costs 50k is technically worth 10k, as utilization can be increased by 5 times. Or Tesla can continue its current cost reduction efforts through streamlining process, driving productivity, and using less parts. All this points to a lesser probability of ASP reducing down from the current 50k to the projected 35k. Hence, ASP can be viewed as a lever to achieve the projected 700 billion revenue in the model. In our original assumption, we have 700 billion from selling 20 million cars at 35k ASP. If ASP remains at 50k today, that's scenario 4, and Tesla will only need to sell 14 million cars come 2030 instead of 20 million. That's 30% lower for holding the current price point. So Tesla can tweak between units and ASP to achieve the same projected revenue of 700B. I'll use a simple example to explain what's a price multiple. Imagine you have been buying 2 apples at $3 each for a total of $6. If you buy 4 apples instead of 2, that will cost you $12, assuming each apple price remains unchanged. If apples happen to be in high demand, then the stores will raise price from $3 per apple to $5. To buy the same 2 apples, you will need $10 instead of $6 previously. Similarly, the price of apples can drop and your cost will be lesser. How will this relate to the stock price? You can picture apples as an asset that an investor is buying to derive the benefit of having future cash flows or revenue in this case. To buy the apple on the asset, you will have to pay a price which is the multiple. In other words, how much are you willing to pay for each dollar of revenue? If you are to pay a multiple of 3 per dollar of sales, then you will be buying a company generating $2 of annual sales at a cost of $6, which is the market cap or your investor capital. It's important to note that valuation is driven by 2 factors. One is the actual fundamentals in terms of how much sales the assets produce. Second is the multiple which we talk about here, and it increase and decrease depending on the market sentiment. How do we know what's a reasonable multiple? We can use a relative valuation model, which means comparing peer companies to see how much they are currently trading at. You can derive the multiple yourself by taking market cap divided by revenue, or per share basis it will be share price divided by revenue per share. Or you can simply retrieve the numbers from websites like Morningstar. Determining the multiple is more of an art than a science, as really subjective across investors and varies across time. When the market is optimistic, the multiple expands and it contracts when otherwise. Price to sales multiple across companies vary depending on the growth rates and profitability as well. A high growth or high margin business naturally commands a higher business, and investors are willing to pay more for it. Remember what we discussed on the demand of apples just now? I've selected 6 peer companies and we can separate them into 2 groups. The first group are the traditional automakers, who are Volkswagen, Toyota, GM and Ford. We hear that car making is not a profitable business, and it's true for these automakers, as you can see the gross margin at between 14 to 20% and operating margin at only 6 to 8%. This means for every $100 of sales, the operating profit is only $6 to $8. In contrast, Tesla operating margin is about twice, despite selling a million car versus near to 10 million for the others. Once Tesla ramps up further, the economy of scale will further kick in. In fact, if you go read Tesla financials, you see the operating expenses increase modestly each year. Even when revenue massively increase, there's operating leverage for you, which differentiates Tesla from the others. If you look at sales growth, past 5 years were low single digits for traditional automakers. Tesla growth rates were at many times higher. You may argue that they are at low base, but they have high operating leverage, which means the profit increased much more than revenue growth. In other words, for every dollar of incremental revenue, Tesla generates more than a dollar of additional profits. These are some important factors investors will bear in mind for the market to price Tesla at 21, which is many times higher than other automakers. If you look at the next group, the two comparable companies are NIO and BYD. These are up and coming EV companies from China. You can see that they have very high growth rates as compared to traditional OEM as they are growing their EV business from a relatively small base. Hence, their multiples are also higher at 2 to 5. Also, it's notable that the gross and operating margin of BYD NIO still lags that of Tesla by quite a fair bit. This is why most will agree that Tesla is the only EV company to have scaled by production plus making profits in the process of doing so. Hence, the next question is, do these benefits justify the current multiple of 21 for Tesla? This slide shows the growth and profitability strength that Tesla has against others, and is still at early growth stage given Tesla relatively small annual sales of 1 million per year now. Also, some may suggest that Tesla is viewed as a software and AI company, which means a higher profitability profile than a pure car maker. These reasons may lead the market to assign a higher multiple to Tesla. Remember, we are only looking at auto business for this valuation purpose. We use price to sales multiple of 5 in the model, which is a significant haircut from the current multiple of 21.5 now. 5 is reasonable to me, but it's really subjective, so you will need to make your own judgment. Now that we have the three variables, we can combine them to derive the share price. Our original assumptions are in scenario 1 with 20 annual car sales at $35 of average selling price and a multiple of 5 to derive 3,500 per share. That's an implied return of 15% CAGR if the stock is bought at $1,000 and assuming share count remains at about 1 billion. But valuation is not a number but a possible range. Fundamentals may improve or worsen depending on execution, and multiples may change together with these numbers, financial numbers, and also with market sentiment. Therefore, it's important to do scenario analysis to know your best case, or possible worst scenarios. In scenario 2, the market may be pessimistic or going through a recession, resulting in a multiple of 1 instead of the projected 5. This will imply a share price of only $700 and a loss of 4% CAGR on CAGR basis, so do bear in mind the possibility of losing money and to size up your investment appropriately. Or things will turn out better, like in scenario 3 where market was optimistic enough to give Tesla a multiple of 10 even though it didn't meet the 20 million projection. The multiple expansion will have huge impact with an implied share price of 6,300 and 23% CAGR returns. The purpose of this exercise is to show you how the valuation can be so sensitive to the assumptions we have used in terms of fundamentals and multiples. The values are for discussion only, so do input your own numbers and do your own risk assessment. To end off, we have spoken at length about the 3,500 valuation of the auto business only. All other business verticals are not priced in and views as optionality or bonus. Also, we saw for a previous model that Tesla may have a 10 trillion scenario come 2030 for the company as a whole, including insurance, FSD, and energy. I hope this video has helped you to simplify valuation models and concepts to help in your understanding. More importantly, you should realize that to have a good model, you should have done in-depth research and first be convinced of company quality before diving into valuation. That's all I have. Do comment if you find this too simple or too complicated, or how I can do better in explaining these concepts. Appreciate if you can like the video and subscribe to the channel. Thanks for listening.